To the Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for the Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us on a weekly basis. We really appreciate it, appreciate the feedback. We're on KCAA, that's in the Inland Empire. All our friends out there been on that radio station for about 10 years. AM/FM signals bringing to you the best mortgage information that you can get anywhere on the radio. And why do I know this? Because I listen. I see what's out there in the marketplace. And you know what? If you're looking for firsthand information and people that you can rely on, you can come to us each and every week. And we come to you, as I said, on Saturday and Sunday. You can also go to KCAA website. If you go to that website, not only this week's show, but past shows. We have many years, 10 years worth of shows. I don't know how many are archived, but certainly the last 18 months or so. And it's interesting to see how the trends in the mortgage interest rates, as well as the programs being offered, difficulties of getting a loan, whether you're in that category of low FICO scores or high FICO scores. What are the loans for you? Do you need to go to the non-QM route, which are a little bit higher, but also a little bit easier to get? All these information is available to you. If you want to see me, go to YouTube, Jeff Barton, the Mortgage Voice on YouTube, and that's where you can see me again. All the archive shows that have been on there for year after year after year. And again, for me, the best part of that is I get to see myself. I get to see the people who come on the show. You can also go to themortgagevoice.com. It's another way to get the information from us. Contact the guests individually and by yourself. Nobody has to know what you're doing. Just contact them. We always have great guests on the show, people who come to us and talk about rates, and they talk about differences in why this particular program is good now versus what it was good last week, what was good last week, and what's going to be available in the future. Most of the reps that we have on the show have been in the business for years and years and years, friends of mine that I've known. And again, this week is no exception. We're going to bring to the show about 3 or 4 different guests that are going to talk about the rates, the programs, the market, and where you stand in it and what they're trying to do in order to get it. Okay, again, I'm Jeff Barton. This is the Mortgage Voice. And again, thanks for listening to the show. The mortgage interest rates, we always bang out the show right at the beginning with what is hot in terms of the mortgage interest rates. I can say honestly that this 7% ceiling and floor has been around for about 2 months. And whether we see a reduction based on what the Fed is doing or based on what the mortgage bonds are doing or just based on market conditions in general, I think we're going to see 7% or thereabouts, a little above, a little below, for the rest of the year. I just don't see this particular economy changing all that much. I do see some good signs on inflation. I do see some good signs that it looks as if the economy is going to be good for the foreseeable future, and that's about 6 months, and that'll get us by the election. And everybody who watched that absolutely horrible debate the other night is settling into the fact that we're probably going to get a change in presidency. One of the good things about the debate, and it was a very short moment or two, for people like us who talk about housing, who talk about mortgages and the interest rates thereabouts, there was some small a bit of information about housing in the debate. It came out of Biden's mouth. And I went to my local and my guy that I always go to, and it's on Housing Wire, Logan Matashami, who is the economist over at Housing Wire. Housing Wire is a great source of information. It's kind of industry, but at the same time, you do get to see what's going on out there and what drives us in the business to do what we do. But this economist talked about several things. He said, look, what they offered in terms of programs or solutions for the economy. He had his take on it, and I'll just go through a little of it so you're aware of what's happening in terms of what's going on in the presidential election year about housing and about mortgage interest rates. Okay, about housing. 2 million supply. That was what Biden had said he wanted to bring to the economy. 2 million new homes. And Logan said, yes, that's a good thing. He also said rent control. And I, as well as he, don't think that's a good idea. I don't think it's a good idea because what it does is it caps the available profit in any market. And what happens is the market doesn't play as big a role, and therefore the investment in something that you have a capped return on your money, that's not a good thing, and that's anti. So he's a no on that. I'm a no on that as well. The first-time home buyer's credit is a yes. I'm not saying no to it. I just don't know enough about it. How do you qualify? What does it really mean? Who's giving you the credit? Where does the money come from? All that kind of stuff. I'm basically a very conservative person when it comes to spending money, or basically spending your money. If I was in that position, I would be very hesitant as to say, yes, I'm all for these things that give people money, without knowing exactly how I was going to get that money and where it was going to come. So these three things, that's 2 yeses and a no from Logan. I'm one yes, one no, and a maybe. He came to the conclusion, as well as I do, that supply is the best thing. The only way to increase supply of housing in the marketplace is to, one, try to do away with some of the regulations that it requires. I know that in some areas, especially in California, where we deal with a lot of environmental issues, we deal with a lot of insurance issues, we deal with earthquakes and fires, there are many restrictions on building, which is more than just your local building and safety, which says you have to have a building like this, and you have to have a certain strength to the building for earthquakes, you have to have a certain fire for fire season. But there are many regulations, whether, as I said, they're environmental or they're beyond the scope of what a local municipality would ask you as a home builder. And the large home builders have really stayed away from areas like California because of the wildfires and the earthquakes. And so we do get some building up to 15, as everyone knows. And we do get some down in the Murrieta, and we do get some down in Tehachapi and some of the other places in the IE. And again, everybody out there, hello. San Bernardino, Riverside counties, we say hello each and every week, and I just don't want to remiss and say, hey, you know what, I forgot you? No, I don't. But in terms of what's happening and how it affects you in your home buying process, these things that come from, the big people up above, or from our friendly neighborhood economist, Logan, you have to take them into consideration. I mean, obviously, each and every buyer is different. And each and every buyer has their own specific needs and their own specific requirements, whether it be your FICO score is bad, whether it means you need more income, or whether it means you need more down payment. And this is all for house purchases, of course. Anybody who's looking to take money out of their house in order to, the big three, right? You have health reasons, you have college reasons, or you have retirement investment that you want to do to add another stream of income to what you already have. Well, what happens if you're stuck in a 3 or 4 or 5% interest rate on your house? You're not stuck. Obviously, that's a great interest rate. But you can't tap into that equity unless you either refinance the whole thing or get a second or get some kind of a HELOC. All of these things are what you need to consider. And when that particular lock-in will become something that's in the past, 80% or over 80% of people have under 6% mortgages. And right now we've got 7% as our base, 30-year fixed. So, you figure it out. Nobody's going to want to refinance those things. I'll quickly get to what the interest rates are. I went on a bit of a tangent about what's happening not only locally, but also what Logan was talking about in terms of you and your buying season and what is happening in the presidential debate on housing. 7.14 is the 30-year fix, 6.49 is the 15-year, 6.62 is the FHA, 7.30 is the jumbo, and 6.64 is VA. The 2 years at 4.74. 4.774. The 10 is at 4.48, about 30 basis points. We've seen a shrinking of this basis points, and they've made on several of the websites I go to, Mortgage News Daily is one of them. They make a big deal about the spread, right? And not so much as to this portends a recession, but now they're talking about, okay, since the spread is narrowing, that is an indication that what we have here is a narrowing of the 2 and the 10, and it keeps the interest rates kind of where they are. And one of the reasons for that is that the spread, when it was higher or when it was lower, was wider. And now that it's narrower, it really indicates that where we are is probably where we're going to stay for the long term. I don't know. This trying to understand what the 2 and the 10 are doing and how it affects you. I just know that if we used to look at the 10, that would say, okay, your rates are probably this. I would say in a normal market. Is it a normal market now? No, it's not. Anyway, we'll get more of that later on in the show. I'm Jeff Barton, your voice in the mortgage industry. Thanks for tuning in. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, and I am the resident expert here at the Mortgage Voice to talk about what's happening both locally as well as what's happening nationally in the economy, as well as the rates and the programs and the scarcity of good loans, good loan rates. And most people who come to the table and want to buy a house, first thing they ask their mortgage professional, their mortgage loan officer is, hey, what are the rates? Well, as we know on this show, we talk about non-QM a lot. We talk about different types of loans, different types of funding sources, and a different way by which those are underwritten. There's a lot of ways I can go with that particular sentiment, but one of the ways that we're looking to reduce overall costs, I was listening to, and it was a tough listen because he just doesn't have a radio-friendly voice. Has a lot of knowledge, smart guy, but it's the head of the CFPB. No, head of the CFPB? Yes, the head of the CFPB was talking on Housing Wire, and I was listening. Is it the Housing Wire or Mortgage News Daily? One of the two sites, talking about how junk fees are what they're going after. And it seems to be a refrain, something that we've heard again and again for the last 25, 30 years. It used to be title, insurance, and the fees, junk fees that they charge, and now it's more about just a plethora of different fees that consumers are complaining about, according to what the head of the CFPB is. And I'm remiss because I didn't write down the guy's name. It was a name I'm not all that familiar with, even though they've been in the job for quite some time. But as is always, going after junk fees, small fees, those fees that don't really seem to make sense in terms of what the consumer is aware of what they're spending, that's what they're going after, and they're trying to shorten that ability for either lenders or title companies or escrow companies or whoever it is company to tack on the $50 fee, the $25 fee, the $117 fee, whatever it is. If you're pulling your credit or if they're pulling their credit for you and those fees show up as a $53 fee, is it really $53 or is it $46.50? These are the kind of junk fees that they're looking at to combat. And I'm thinking, as I'm listening to this, no, this is not the most pressing issue, even though the Consumer Finance Protection Bureau has the mandate to get out there and see what's going on in the marketplace and correct it, and if there are offenders, take those people to the woodshed. I understand all that. But to me, it's the availability of funds and the ease by which a borrower can borrow those funds. Tightening of lending restrictions on a loan is really what has happened over the past COVID years, right? What we saw is, since COVID has happened, we've seen restriction on the amount of money available because of the tightening that the Fed put on. Now, I was thinking, and that's not a good thing sometimes, but if it was a good thing, and I said, look, there is money out there to lend, but it's difficult in the debt that we accrue as people who borrow money. That debt needs to be sold. If that debt can't compete with government debts that's being sold or private equity money that's being sold, then it's a loan that has to sit on your books until those times where you can actually unload that. Now, there aren't enough lenders out there with deep enough pockets to be able to take on 1 million loans, let's say, at a certain percentage below what currently Fannie and Freddie is selling. As I said, it's 7.14 is the 30-year fix. It's been around 7% for the last 6 months. if we could get a loan for 5%, where are you going to sell that loan? You can't, because the yield that they're receiving on mortgage-backed securities or any other kind of debt that the treasuries that the U.S. government is involved with is yielding more than what you're going to yield at a 5% mortgage-backed security. So even if you wanted to, even if there were people out there that had plenty of money that said, you know what, if we were to solve this problem, this is how we would go about it. We would sell cheaper loans. Well, you can't do it. So we all are waiting. The private market, those of us that are in government loans, we are waiting for the Fed to eventually say, okay, inflation is under control, let's drop our interest rates, and then tangentially, because the yield on those rates that they were getting previously are now less, that means everybody else can breathe a sigh of relief and lower their yield on their debt. Because as long as we're all in the same ballpark, that means that depending on the criteria for selling the debt, at least with the rate and the yield involved, we can all sort of say, okay, we're all competing against each other, as opposed to I can't compete against them because those are the people selling the loans, and with my loans being what they are, who am I going to sell this to because the yield isn't high enough? If that's not confusing enough, let's get to some other things that might be a little bit simpler for you to understand. The real estate market. Okay, we have predictions that real estate market is going to soften quite a bit. So we went to the archives and looked up what is happening out there in America in terms of real estate, both statewide, citywide, and what may be coming up in the next 6 months. Okay, the cities that have already dropped in terms of their real estate prices, it may surprise you. Austin, Texas, down 12.4%. Coeur d'Alene, Idaho, down 8%. Punta Gorda, which is down in Florida, down 7.5%. Idaho Falls, down 7.2%. And Pueblo, Colorado, down 6%. These are cities in America where the real estate prices have dropped. Now, we in Southern California are looking for that, right? Prices to drop. And, of course, when prices drop, you're going to find more people jumping in the market, which will, of course, raise the price of the house. It's a vicious cycle, and as they said in the debate, we need more housing. Okay, states that have dropped. Idaho, we just mentioned 2 cities in Idaho, down 4%. Montana, down 2.8%. Wyoming, 1.7%. Okay, none of those places are you moving to. You're in Southern California. You're not moving to Wyoming. It's just not happening. Okay, but that's what's trending across the U.S. And then 2 other places, D.C. is at 1.7% down, and Utah is at 1.3%. Now, you may look at Utah because it's, it's 500-600 miles away, but it's not 1,000 miles away. Anyway, so when looking at cities, there are some cities that are predicted over the next 6 months to lower in value, and a couple of them are here in California or close thereby. San Francisco down 5 to 10% by the end of the year. Now, it is so overinflated there, I don't even know if that's good for us here in Southern California to see that. I didn't see Los Angeles on the map. I didn't see San Bernardino. I didn't see Riverside. I didn't see Rancho. I didn't see Palm Springs. I didn't see anything in that area dropping, although they are, obviously 20 to 30% lower than Los Angeles or into Orange County in terms of the prices lowering. However, the other couple of cities on this, New York City down 5 to 8%, Honolulu down 4 to 6%, Miami 3 to 5%, and Las Vegas, interesting enough, 4 to 7%. Now, Las Vegas has been growing exponentially. They got all the sports teams and going to have baseball in a couple, 3 years. It has become a different place. Although the exodus from California to go to Vegas is still extremely strong, seeing prices drop is it's just one of those things where you go, huh? Okay, also, personal consumption expenditure, which is a measure of inflation. As I said, inflation, good news on the inflation front. We'll have more news next week for you. It comes out Friday. We record on Tuesday this week. The PCE report in June rose 2.6%. That's the lowest annual rate since March of 2022. That's a pretty interesting thing, 2.6. Think about that. We're looking at 2% inflation as the benchmark and where we want to go, according to the Fed. maybe we're not that far off. We'll just have to see as they say, where the data leads us. The personal income rose 0.5%. That's good. And consumer spending was off to 0.2%. That means that the economy is cooling. Now, they like to attack the labor market in order to have inflation be more under control. It's something that I wish there was a better way to do it, and I'm not smart enough to give you the answer, but that is where we are right now. Let's see. I got a bunch of things here, but I can't get to it because we're at the end of the 10-minute segment. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening to us each and every week as we bring to you the best possible news to use. And all of it really points to rates, it points to programs, it points to the people we bring on the show. And you know what? We bring the best guests on for a mortgage talk show. We just do. We bring people who are boots on the ground, work for good companies, and bringing you the best products available in Southern California. Next guest, who's been on the show several times before, Carranza from Mega Capital. He joins us now, and it's no exception. He's one of the best. Thanks, Louis, for coming on the show. How are you?
I'm doing well, Jeff. Thank you so much for having me again. It's always a pleasure to be on your show. Thank you.
Excellent. Okay, so Mega, what is happening there? Where do you see the market going, and what kind of loan products might you bring to us this summer?
Well, the mortgage business has obviously been a bit of a roller coaster ride, as we all know.
Yep.
Right now, the majority of the business that we're getting and what we're leaning towards is more the non-QM.
Okay.
The bank statements. We've got written VOEs, profit and loss, 1099 only, DSCRs, asset utilization. Those type of programs are the ones that seem to be getting the most attention probably in the last 6 to 8 months.
So in your product mix, do you see more purchase or refinance? Probably purchase, right?
Definitely more purchases than refis. I mean, the majority of the people, the last few years, refinance, they've got something in the 3s or 4s. And,
yeah, of course.
We're not anywhere near there. So it's mostly purchases right now that we're seeing and in the non-QM space.
Yeah, I love the non-QM space for a couple of reasons. One, the customer is looking for a lower documentation type loan. And two, there are funds available and people ready to obviously purchase those loans once you've funded them. Is that right?
Absolutely, yeah. And the people have been coming out of the woodworks, the investors that are switching more to non-QM where, when rates were low, it was mostly Fannie, Freddie,
right.
The government loans too. But now it's sort of switching gears. Not so much now. It has been for quite several months. But
yeah, at least a year, right? At least a year and a half maybe.
Yeah, definitely. And more so probably in the last 6 months or so.
Okay, now I don't know if you watch what's happening with the Fed. I think everybody in our business does, but at the same time, looking at inflation, looking at what the Fed is saying about inflation, we did see some interesting reduction in overall inflation over the last month. I think we'll see some more coming Friday when the news comes available to us about the PCE and some of the other things. Where do you stand in terms of what the Fed is doing and how that, even though it is not a direct effect, affects interest rates overall?
I mean, I think you're right. It's, we're going to see some movement maybe next week, but I don't see them improving. Jesus, a lot of people saying that not even into 2025. A lot of people said at the end of this year, but now it's sort of being pushed back into 2025 for us to see a little bit more. With all this inflation, it just needs to get back to where it needs to be able to be rates to be competitive again.
What do you think that sweet spot is? Do you think it's between 5% and 6% lower?
I think so. I mean, we've had a couple of dips. We still do, the Fannie and Freddie papers. It's been in the 6s. I mean, I've been surprised sometimes. We've had some, depending on the FICO scores and the LTVs, obviously, but we've had some in the low 6s. So I don't think we'll see it in the 4s, maybe high 4s, but I'd say probably mid 5s or so, mid 5s,
Yeah, I think so too. I like that just because historically 5% was like, oh my gosh, we'll never get a rate this low again. So anything, if it's 5.5 to 6.5 in that range, I think you'll see a lot of people jump back in the market. And I think being poised to be able to take advantage of that. How is Mega looking to position itself for when eventually that happens? Do they gear up? Do they get more technology driven in terms of driving down overall operational costs to be able to meet the demand? How are you guys handling that?
Yeah, we're actually in the process of doing that as we speak. We're up with our technology now more towards the non-QM space.
Okay.
And we've got people that are, we've hired more people, underwriters and things of that sort in the non-QM portfolio. We're doing some interesting jumbos as well, but the non-QM really is mostly that in government. I mean, government's pretty stable year round. Got, lower than people 3.5% down. Those are fairly stable, mostly purchases.
Okay.
But, yeah.
Tell me a little bit about your non-QM bank statement program. How many do you have? What are the types of programs? What are you looking for in terms of FICO and down payment?
Yeah, we've got 4 different types of bank statement programs.
Okay.
A lot of them, we've got some that go up to 90%, so 10% down. Of course, we're looking at the higher FICO bracket for those, probably about 720, so not super high, but still, not in the low.
Aren't most loans nowadays, even with non-QM, above 700, or is that not true?
I mean, we're pretty lenient when it comes to the lower LTV, so if they've got a little more skin in the game, we'll drop down to 660 on some of our programs. As long as we're looking at the 25% down to get a 660, FICO score. So as long as they've got a little skin in the game, we're willing to go the riskier ROE. With the situation, a lot of people have a lot of credit debt, not necessarily bad credit. It's just that they're maxed out, and the system just hits them hard sometimes when they're close to maxed out. So it's not that you have a negligent borrower that mismanages their funds. It's just their economy. Unfortunately, it's reality right now for a lot of people.
Yeah, you know what? Interesting. Explain that to people, why it is somebody who has not missed a payment but maybe overextended in their credit cards will have a lower FICO score than someone who, obviously missed a payment or two but, aren't maxed out on their credit cards.
Yeah, well, historically, the FICO scores, I mean, some of the things make sense, others not so much, but, they have their rhyme and reason for everything. So ideally, what they want to see in a perfect world is 25% of the balance. So, if you've got a $1,000 line of credit on your credit card, if you keep it at $250, they like that because it's not. If it's zero, then they can't really see. They're like, well, he's not a heavy credit user, so they don't have anything to go by.
Right.
But if you have it maxed out, they're like, okay, this guy is mismanaging his funds. Maybe there's some income issues. He's living off his credit cards. So that drops the FICO. So the full spectrum, not using them and using them too much is bad. 50% is decent, but that 25% sweet spot is where you seem to get the highest FICO scores, where they say, okay, he's using his credit cards, managing them. They still have a 75% balance on those, and that seems to be where they like to see the FICO scores go up higher.
Now, do you do automated underwriting with that kind of stuff? So it's just spit out from a computer program, or is this a person actually looking at it, where you might be able to tell a story? Yeah,
we on the non-QM, it's more of a person. We want to see somebody manually underwrite it because there's a lot of scenarios. I mean, I've seen some scenarios lately where it's just situations that you just think, wow, it's, sometimes it's bad luck, but rarely is it mismanaged funds like we saw back in 2007, when the subprime market, I mean, that was a whole different ball of wax.
Sure it was. Yeah.
It's just a lot of people having hard times. COVID didn't help. That really hit people hard. Businesses closing, having to switch gears, changing careers, things of that sort. And starting businesses, we see a lot of people, or I actually see a lot of people that are, they're just not quite at the 2-year mark for their self-employed business.
Yep.
They're just starting, and that's where they want to see, hey, let me see 2-year history, because a lot of people, their businesses have aren't able to function after a year. They close down.
Right.
So a 2-year mark right now is where we have a lot of people struggling to get to, and that's where we are with, we use some of the non-QM because we say, okay, we use a combination of both self-employed and full doc. So maybe the husband's self-employed, the wife's W-2'd.
Oh, I see. So you can do kind of a hybrid type loan. Right.
Yeah, we do a lot of those. We blend them, even with bank statements. We use some
Okay.
where we use 12-month business or personal bank statements, and we blend it with the W-2 pay stub as well. So you just kind of help that debt ratio drop. It's just trying to be as creative as possible to help everybody.
Hey, Louis, we've come to the end of it. I really appreciate you coming on the show. Would you let people know how they might be able to get in touch with you and get advantage of some of these programs you're offering?
Sure, absolutely. Yeah, I work for Omega Capital Funding, and you can reach me on my cell, and that's area code 310-658-8870.
Excellent. Louis, thanks very much for coming on. Always appreciate it, and good info. Thanks.
Oh, you're welcome, Jeff. Thank you for having me.
Thank you very much. That's Louis Carranza from Mega Capital Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week. We try to bring to you the best information. I know it's difficult out there. I don't know if you're a first-time home buyer or somebody that's locked into a low interest rate and you just can't access that money that you want to because you have to have an operation or send somebody to college, or you just want to invest in something. There's a lot of problems out there. But what we try to do on this show, and we do it each and every week, and we've been doing it for 10 years, is bring you some solutions. And not my solutions, of course. I just give you some history and update. But the people we bring on the show are the solution people and the problem solvers. And this next guest, my second guest of the day, Chris Calderon from Forward Mortgage, is the guy that can help you do that. Chris, welcome to the show. Thanks for doing this.
How you doing, sir?
I'm great, thanks. Thanks very much. Hope you like that intro.
I surely did. What's going on, boss man?
Hey, okay, so, yeah, everybody out there is so tired of it. I mean, first thing and first question out of everybody's mouth is always, what's the rate? What's your answer when somebody asks you that?
Right now, it depends. It can vary from week to week.
Right.
One day you're in the mid-sixes. Next day you're in the sevens.
Right.
So it really just kind of depends. Are we talking prime? Are we talking non-QM? So generally, I'll just answer anywhere from 6.5 to 7.
Right. No, and that's a good answer, because I think what that does is it spikes the curiosity of the listener by saying, well, what do you mean? It could be this, it could be that. Tell me about how I can get the lowest possible rate, or tell me how I can quickly get into the property I want to buy. What do you answer when somebody is like that?
When someone asks that, my first question is, are you wage earned? Are you self-employed?
Okay.
Do you file your taxes, right?
Okay.
You've seen a lot of lenders, kind of start to tighten up their guidelines.
Right.
Which has been happening for a couple of years now. I'd say maybe since the beginning of 2022. So really right now, what we're seeing a lot of is the structuring of loans has become a little bit more challenging.
Yep.
And so you need more out-of-the-box creative thinking.
Okay. And what does that actually mean? I know people say that. It used to be the catch-all phrase was think outside the box, or any such wording. And I know for you and me, we're talking about a different kind of program, a way by which we can present you to the underwriter to be able to say, hey, this person is like this, not like this. How do you approach it, and what kind of programs are we talking about?
So here's how we approach it. We understand that borrowers don't live their lives to underwriting guidelines, right? Borrowers are going to do things that maybe, banks won't understand. And borrowers are going to look at banks and say, you're doing things that we don't understand. So again, when I use the term think outside the box, I think really more what I mean to say is we think with inside the box, we just have a bigger box.
Okay.
Whether it's bank statement programs for borrowers who are self-employed, some DSCR products. You might have some people that own a bunch of rental properties that maybe don't claim enough income, so we can just go off of the income they earn off the rental properties. We have some really good FHA down payment assistance programs.
Okay.
Obviously, with prices being as high as they are historically, right, some people might have some money saved, but they might need a little bit of extra help to kind of get them across the goal line. Not only that, just kind of like our culture that we built from like the underwriting. Again, my underwriters are just flexible. They understand borrowers are not living their lives to underwriting guidelines, and that's kind of really what we stress. So again, we want to look at things a little bit more from how could we make it work as opposed to how could we shut it down.
Are you looking to the future when rates do eventually fall, either 2026 or 27, and how the model that we currently have, which is, a lot of underwriters looking at files, moving it to a technology-driven underwriting process more? Because as I read more and more about it, all the big banks and all the big, the UWMs or the Quicken or Rocket people, this seems to be the way they're trying to either get rid of people, lower their costs, or increase their margins. How are you in this space being able to, keep up with that, especially when you're going to get the demand that is inevitably coming when rates get lowered?
Got it. So I'm a little bit more hawkish on when I think rates are going to come down.
Okay.
I think one of the things that people aren't paying attention to is really what's going on in the economy. When you've got figures that are coming out, when you've got a spike in borrowers making minimum payments on their credit cards, when you got a spike in charge-off rates on credit cards that we haven't seen since 2008, when you have a spike in in Americans taking out 401k withdrawals, you might see the unemployment rate low. You might see inflation starting to come down, but Americans are still really hurting. One of the things that people forget is if inflation comes down, it doesn't mean the price of goods and services comes down. It just means that they're not increasingly as rapidly as they are. Right. And so those are the things when people are saying, even last year when people were telling me, Chris, we're going to see, rates drop in 2024, I was like, based off the data, I don't think so. Based off, the history that I've read off of Jerome Powell, I don't think so. So I realistically don't see rates coming down maybe until 2026. Now, does that mean that we might not see a quarter drop at the end of the year? It's possible, but because home prices have gone up so much, it'll be canceled out by how much home prices have risen since the last time we saw rates lower. So I think it'll be canceled out then. Now, the second part to your question was in regards to artificial intelligence, AI. We're also working on that as well.
Okay.
But at the end of the day, what I remind people is it's not AI that's going to be using people. It's people that are going to be using AI. And I think that's one thing that people forget. They get a little fearful about AI.
Sure.
AI is going to help make things more efficient. AI will cost people some jobs, but AI is going to create a lot of newer type of jobs. Kind of like something that we saw back in the Industrial Revolution, 120, 130 years ago, right? Now, so AI will be implemented, I think, by the end of the decade, which sounds like a long time away, but it's really not. I think AI is going to be a huge, huge factor in our industry. But at the end of the day, it's going to require, lending will always require a human touch, because as long as borrowers, like I said before, as long as borrowers don't live their lives to underwriting guidelines, you have to have a human on the other end of that computer to make these loans work.
It's so interesting because there is such a divergence in what you read and what people are predicting. Like you're as you said, a conservative or more of a hawkish person on when rates are going to fall, and I completely see and agree with you on that particular front. And the other side is, of course, nobody really knows because this is really uncharted territories. But the hard facts of credit card debt, delinquencies, auto loans being called, there are a lot of indications that, as you just said, people are hurting. They're trying to live the best life they were living during COVID when money was just handed to them, but it's not there. When do we start to see the economy reflect those numbers? And then therefore, when the economy slows, that's when we usually see rates drop significantly.
So historically, after the last rate hike, right, typically 11 months after the last Fed rate hike is when we generally tend to see a recession falling.
Okay.
Well, the last rate hike was in September of last year. So obviously we're running on that 11 months next month.
Right.
Now, it doesn't mean August 1st a recession hits, right? And again, it's not a rule of economics, but typically that's what we've seen after the Fed has gone through, large rate hike cycles like we've seen over the past couple of years.
Right.
But I really think that we're really going to start to see the economy start to slow, right? Maybe by the end of this year, beginning of next year, right? And again, I'm not talking politics, regardless of who gets in the White House.
That was the next question. Yeah. Okay. Good.
Right. Regardless of who gets in. Now, depending on who gets in, will dictate how quickly it could be fixed. Now, if you're looking to Trump, I think if Trump was to get elected back into office, I could see rates going down, right?
Right.
But it might have the reverse effect because it might cause prices to go up. Now, what we have seen, right? What we have seen is we've seen a huge spike in listings. Right. Now, granted, it's local depending on where you're at. Southern California might be different than maybe Columbus, Ohio, for instance.
Of course.
Right.
Yep.
So we have seen a huge spike. But one thing I've told some of my clients is this, right? We're on pace for the fewest amount of homes sold since 1995.
Oh, it's awful.
So we're going to have the fewest amount of homes sold.
Right,
since 1995. But yet there's 60 million more people living in the United States.
Right.
So to me, that says a lot about where the state of our of the housing industry is at. Now, what we are seeing a lot of, right? We are seeing a lot of, and this is me going back to the 401k withdrawals, people, now making minimum payments on their credit cards. We are seeing a lot of people refinancing those 2.875, 3.5 interest rates to pay off debt, and they're taking a 7%, or they're taking a 6.5%. Right? Now, I know you might be asking, well, why don't some of those borrowers keep that low rate and just take out a closed-end second? Well, in some cases, depending on the situation, when you do the blended rate, the borrower might be better off just refinancing out of that 2.5%, 3%, 3.5%, taking a 7%, and then when rates eventually do come down, again, they're never going to go back. At least I don't see any time soon going back to that low of an interest rate. But maybe they might be able to refinance to a 6, 5.5, or a 5.
Right.
And so we're seeing a lot of that. And one of the things that a lot of my brokers are telling their borrowers is, why are you so worried about that 3.5%, but you're paying a 19%, a 29%
on a second, right? Of course, on the credit cards too, right? I mean, right, exactly. If you got 2 or 3 credit cards and you've got $30,000-$40,000 on them at 30%, maybe it's time to get into a 7% and make the payments. It's about cutting the credit cards for most people. They just can't seem to wean themselves off that lifestyle they had during COVID.
Correct. You nailed it on the head.
Right. Hey, Chris, we have run out of time. I wish we had more time. What you're talking about is extremely interesting. Want to have you back. Obviously, we always say that, but it's true, and you've got some great insight. But if you could let people know how they can get in touch with you at Forward Lending, that'd be great.
You got it. You guys could always use my cell phone, area code 818-926-7078. Once again, 818-926-7078.
Chris, thank you very much for coming on. Always appreciate it.
You got it. Appreciate it. Take care. Bye-bye.
Thank you. That's Chris Calderon from Forward Lending. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show each and every week. We come to you, bring to you the best information that's available out there. It's current, it's topical, and we try to bring solutions in the people that we bring to the show. If you want to see and hear this show, we're on a number of different podcasts. Daryl, do you have a list of those for us?
I sure do, Jeff. It's Apple Podcasts, Google Podcasts, Spotify, Spreaker, Stitcher, iHeartMedia, Odyssey, YouTube, podclips.io, and themortgagevoice.com.
Okay, all of those great places to go and hear what we do each and every week. KCAA.com is another great place. The Mortgage Voice on YouTube is another good place, and that podclips.io. Central place, lots of great podcasters. Go there if you just want one place to get a lot of different great and variety of type shows. Mine is one of them, and there are a lot of other ones too. Podclips.io. Thank you very much again for coming on the show. Okay, each week we bring great guests. I know I say that a lot, but it's true. We have seasoned people who have been in the business a long time. They're kind to come on for me, and I do appreciate that, but they bring to you a wealth of information and experience, so you don't have to shop around and look for somebody to talk to. These are the people that you can do it for. Dean Garrett from Remen Real Estate Mortgage Network is joining us again. He's one of these people. Dean, how are you?
Oh, doing good, Jeff. Another day in paradise, right?
Excellent. Yes, another day in paradise. Absolutely. Outside of the weather turning hot everywhere, even here, how's the business, and what are you thinking about in terms of products you might be offering for the rest of the summer?
Yeah, actually, Jeff, as we say, it is what it is, right? We just got to keep moving forward. But what product that's been our hottest product here is our HELOC.
Okay.
And it's pretty interesting. What happens on these it's a separate portal.
Okay.
And you can go in there and you can fill out an application. You can also, brand the link and send it out to your borrowers. It's an 80%, interest only 5 years, then a 25-year payback based off prime. Whatever the margin is. This is a new feature that's got us all excited. You can pay off debt now to qualify. For a while, we weren't allowing that, but now go up to 50% with paying off debt.
Okay, explain that. Now, we talk numbers and programs like our audience knows what we're talking about. I know what it is. It sounds awesome. Explain it really slowly.
Okay. So the HELOC, home equity line of credit,
right,
to be based off the equity in the property.
Right.
Now, here's where we can save you some money in the borrowed money is we pull an AVM, rather than a full appraisal.
Okay.
Okay.
Yes.
So based off the AVM on an owner-occupied property, we'll do a second mortgage up to 80% of whatever that AVM comes in at.
Okay.
If it's a second home, we'll go to 75%, and if it's an investment property, we can go to 70% is the max. Okay.
Okay.
The minimum FICO is a 640.
Well, that's good too.
That will reduce your loan to value. But if you have a 740 or better, actually, we're down to a 700 or better. You can do the numbers that I said initially. Okay. But the new feature that I was talking about before, we weren't able to pay off any debt. So if a borrower wanted to pay off debt, they would have had to qualify with that debt and then pay it off on their own.
Right. Right.
Now we can pay it off through the loan to get them qualified. So it's opened up, and now we're getting, I would say, 2-3 times the borrowers approved that we were getting before.
Now, in that, are you looking for a higher FICO score? That's why you're allowing it, or are you just looking for less debt?
Well, it really doesn't matter.
Okay.
Whatever they qualify based off loan to value and credit score, they can pay off their debt. Like I said, it was a little bit of an issue before. People wanted this, but had to qualify with all their debt.
Right. Right. Well,
we kind of do like a limited title on this, and we're just trying to keep the cost down.
Of course. I saw
the best news on it all, Jeff, is we pay our broker 1.75.
Oh, that's excellent too.
Yeah. So you can get paid on them. I know a lot of people are giving them away, but it's a real simple process. It's 5 minutes of your time, and you can make 1.75 of the loan amount.
What is the typical loan amount on these types of seconds? 100,000?
They're pretty high. Here in California, they're probably at least 100.
Right.
I've done the max we'll do is around 400.
I see. Okay.
But and they can go down to 25 if someone just wants a smaller amount. A couple other great features on this is that there's no prepayment penalty.
Oh, that's good too.
So what really helps is it's actually a perfect bridge loan.
Yeah, that's interesting. So, and how would that work in terms of the bridge loan? What are you looking for? A full? You mean on a sale or a rehab or?
Yeah, what I mean on that is someone, is wanting to buy a property, has a little equity in the property they're selling, but haven't been able to sell it yet, or
Right.
or buy the new property because they don't have the funds. They need the funds out of, the old house.
Sure.
So as long as the house isn't listed, you can get a second, get your equity out of this, use that to buy your new home, and then when the house sells, you can pay it off with no penalty.
Well,
For both borrowers and brokers. We don't come back to the broker either.
Well, this is a pretty good loan. I bet it's pretty popular right now.
It is. I think as a company we did, I think it was $45 million last month.
Wow.
Yeah.
Wow. And this is a nationwide program here, or just Southern California?
No, it's nationwide. It's even in Texas now.
Wow. Well, Texas is kind of a state where you can't do more than one refi, right?
Yeah, it's just a little funky with them, what they
Right.
allowed, some rules on that. I'm not all the way familiar. I'm lucky enough not to deal.
Well, that's the way it was for a long time. One time and that's it. You're done. You can't do more than one. But with a HELOC, that's kind of a different type of product anyway. It's not a second. It's not a first. It's a kind of revolving credit line.
Yeah, I know they require like a 12-day cooling off period.
Oh, I see.
Yeah, there are some funky rules on that, but there are some state-specific. I can let anybody know if they had any questions on that, but it's a real easy program, and it's nice on this HELOC, which is a little bit different from the last one we had, is the actual portal where the loan officer can go into it and can see exactly what steps are needed, where we're at with everything, and can follow along. Our old one, there was a more of a mystery on that, but this one is very simple.
And the AVM product that you're using to evaluate the property?
Yes, sir.
Okay, so that's just a desktop a desktop appraisal system, right? And
yeah, was it like automated value?
Yes, I know, but exactly the anachronisms, however they are. But really, for people who are listening, it's just just that someone who is an appraiser just sits it. Go on.
There's no cost on that. Now,
that's
for
nice
some
too.
reason, if the broker is unhappy, because the problem you run into with those AVMs is if there's been some upgrades to the house or renovations,
right?
It may not show. Okay, because all they're doing is basically pulling comps in the neighborhood.
Yeah, right.
If the borrower chooses, they can then pay for a full appraisal if they're not happy with the evaluation.
Right. Well, even at the tip top of a fix-up, your property is only going to vary 15% from the neighborhood. I mean, that's just the way appraisals go anyway. So, you have to weigh whether that extra amount that you're going to get in the AVM, if you get it, and it's not guaranteed that you will, is worth it to wait. I mean, a lot of people who need money need it now. They don't want to wait.
That's the beauty of this program.
Right.
If you need it, we can get it to you pretty quickly.
Oh, that's awesome. Dean, we have run out of time. I can't even believe it. I just looked at the clock.
Wow.
Could you let people know how to get in touch with you? This is a great program, and I think people should be able to take advantage of it. It's a good time of year to do it, too.
Yeah, you could email me at dean.garrett, Garrett, @remn.com, or always call me, 949-357-6444.
Excellent, Dean. Awesome. Thank you very much for coming on the show. Love it.
Thanks for having me, Jeff. Appreciate
Okay.
it. Good talking to you.
Great. Thank you very much. That's Dean Garrett from Remmen. I'm Jeff Barton, your voice in the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.